The Nifty 50 has finally hit a record high, breaking past its September 2024 peak after more than a year. But beneath the surface, the rally is far from uniform. Large caps are powering ahead, while mid caps and small caps lag sharply. So let's break down the biggest gainers, the biggest losers, and the forces driving this turnaround over the past 14 months. However, the divergence across market segments is still quite sharp. The mid-cap index is up just about 1.4% this year, while the small-cap index is actually down more than 5.5%, both still far below their previous highs, while the Nifty surges ahead. In contrast, the large-cap benchmarks have reclaimed momentum, with the Nifty and Sensex gaining nearly 10% so far this year. So now let's take a look at the key gainers and the top losers from peak to peak. Since September 2024, several Nifty 50 heavyweights have delivered very strong returns, with Bharti Airtel up 23% and Indigo rising 20%. Meanwhile, SBI has gained 22%, and the standout performers are actually from the defense and the auto segments. BEL has jumped up nearly 42% and Eicher Motors is up roughly 41%, while Bajaj Finance has rallied around 32% since September 24. On the flip side, several heavyweights are still well below their earlier peaks. NTPC and Coal India are down about 25% each, while TCS has slipped around 26%. Bajaj Auto has fallen 27% from the past September 24 to November 25, but the biggest laggard remains Trent, which is trading about 45% below its previous peak. In terms of market cap shifts since the previous high, there are a few heavyweights that have driven most of the wealth creation. Bharti Airtel leads with an addition of about 2.2 lakh crore, followed by SBI, which has added about 1.9 lakh crore to investors' wealth. On the losing side, the damage has been a bit deeper. TCS has seen the biggest wealth erosion with a market cap loss of over 4 lakh crore rupees, while Infosys has shed about 1.4 lakh crore and HUL is down 1.3 lakh crore rupees. During this time, domestic institutional investors have emerged as a key pillar of support for the markets in the recent months. Since September 26, 2024, DIIs have pumped in almost 9 lakh crore rupees into the markets, offsetting the persistent selling pressure from foreign institutions. Further, strong domestic flows have enabled markets to hold their ground and scale new highs. During this same time, FIIs have actually withdrawn about 2.4 lakh crores from the markets, which is reflecting caution amid global uncertainties and currency volatility. The strong domestic flows have helped stabilize sentiment, absorb volatility, and keep the benchmark indices on an upwards trajectory despite the drag from overseas investors. Well, what are some of the key factors that have led the markets to stage a turnaround? For much of the past year, equity performance was held back by subdued earnings, stretched valuations, geopolitical tensions, and steady foreign outflows. Indian markets also lagged their Asian peers as trade uncertainties and muted profit growth weighed on the domestic sentiment. However, the backdrop has begun to shift. Corporate earnings are improving, valuations have cooled off from their earlier highs, and expectations of global rate cuts are gaining momentum. Strong domestic inflows continue to provide a solid cushion for investors, while foreign selling has started to ease at the margins. In the near term, global equities are also finding strength and rallying ahead of expectations of the US Federal Reserve's upcoming policy meetings, where investors are betting that they will cut the rates. All these factors together have helped fuel the ongoing recovery in the Indian markets. As always, stay tuned to Moneycontrol.com for more news updates and keep watching this space for more.